This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at a small adjustment before we look at the bigger adjustments in the notes. And the first one that we look at is your mid-year acquisition. It's only really an issue in working number 2, so calculating your net asset to the subsidiary, and only an issue in terms of working out the net asset to the subsidiary at the date of acquisition. Because when you have the acquisition of the subsidiary, if it is part way through the year, then you need to work out what the retained earnings were at that date to be able to go through there and work out the net assets at the acquisition date. Remember, to work out the net assets, you take the share capital and add the retained earnings. If you're not given the retained earnings, you need to work out the retained earnings at that date. Okay, so somewhere part way between the year. What we go through and do there is you assume, again, it's an assumption, that the profits made by the subsidiary have accrued evenly. Because what you do there is you can look at your opening retained earnings and your closing retained earnings. We need to work out the retained earnings somewhere in the middle. Okay. If we know the opening and closing retained earnings, hopefully we know what the profit for the year is as well. Once you've got the profit, if that profit's accrued evenly, we know what the profit is for the full 12 months, isn't it? If we know what the profit is for the full 12 months, then we can work out the retained earnings at acquisition by prorating those profits and then taking either the opening retained earnings and adding on a portion of the profits to get to the retained earnings at this point here, or alternatively, taking the retained earnings at the year end and deducting this portion of profits post acquisition to work out the retained earnings at year or at the reporting date. Sounds tough. It shouldn't appear too much within all of the questions. It may be one question, and again, you spot it by seeing the acquisition date, and that acquisition date is somewhere mid-year. Okay, and there's just a little illustration just underneath. Hopefully it will all make sense there. It says Richard acquired 80% of Andy's equity share capital on the 1st of August 20x5. So NCI is 20%, acquisition date is the 1st of August, and the year end is December, isn't it? So we haven't acquired the subsidiary on the first day of an accounting period. We haven't acquired it on the last day, which, if you have spotted, is what we've done in all of the previous questions. It's done partway through the year. It says Andy's retained earnings at the end of the year was 600,000 and its profits were 120. Okay, so given that we have the closing retained earnings of 600, it's that figure, isn't it, that we're then going to adjust. So if you like, work backwards to get to the retained earnings at acquisition. Now, the acquisition was on the 1st of August. The year end is the 31st of December. So post acquisition, there's been August, September, October, November, and December. So since the acquisition date up until the reporting date, there has been 5 months. Okay, if that's the case, we will deduct 5/12 of those profits. Those profits for the year are there as 120,000, and I think that works out. Is it slightly wrong there? I think we'll update that. That's not correct, is it? Okay, 600 less 5/12 multiplied by 120 should be 50,000, shouldn't it? 600 less the 50 gives you, is it 550, isn't it? Okay, just be careful. Okay, I will ensure that in your notes that will say 550. Okay, I'm not going to go back and update it and then re-record everything that I have just said, because that will be a waste of time. Okay, I apologize, but the key bit, hopefully, that you understand it, is that that figure that you have now, the 550,000, goes into your net assets of the subsidiary at the acquisition date, doesn't it? Okay, there we go. Excellent. Everybody happy? Reasonably so. Typos happen, and there we go. So what you've got there is then going through there and looking at the adjustments to the group. And again, the key thing that you then find here is that everything revolves around the fact that we are looking at the group as a single entity. Okay, remember at the start, first video on groups, we had the parent, we had the subsidiary, and then around it was that oval shape which signified the group, wasn't it? We're preparing a set of accounts for that group, which is the single entity. So if you're looking at the parent shareholders, they're looking at the group. They are only concerned with what happens between the group and the outside world. What goes on between the parent and the subsidiary has no relevance to the parent shareholders whatsoever. Okay, they're only interested in what happens between the group and the rest of the universe. Okay, the first thing that we've got there is looking at your intra-company balances. So imagine the parent and the subsidiary trade. They buy and sell goods between each other on credit. So therefore, in one set of books, there will be a receivable. In the other set of books, there will be a payable, won't there? Okay. So legally, one book or one entity has a receivable. Legally, one entity has a payable. But from a group perspective, the group doesn't owe or is owed any money to the outside world. It would be like, say, if you've got any brothers or sisters. If you lend money to your brother or sister, you are due that money back. They owe that money to you. Okay, so between you and your sister, then or you and your brother, there's money owed between the two of you. Okay, but outside of the family, is anything owed? No. So your parents wouldn't care. Okay, it's like, well, sort it out between yourselves. Have a little fight, yeah, scrap over it, and then sort it out at the end. Okay, there may be tears, but the parents are not worried about how much is owed by the brother to the sister and vice versa. Okay, so if that's the case, what we're going to go through and do is we're going to remove the payable. So payable is a credit balance, so we will debit the payable. And the receivable is a debit balance, so we will credit the receivable. Okay, so effectively we are reducing the payable, reducing the receivable. Okay, key bit there is that those intra-company or intra-group balances, again, doesn't matter, same thing, different name, intra-company, intra-group, need to be equal, because if they're not equal, then we're not removing an equal debit and a credit. Okay, so here, intra-company balances are whereby we have that adjustment whereby things are equal. So we have equal intra-company receivable and payable balances. When we go through there and look at your cash in transit, that is when we have unequal balances. Okay, so what you tend to have there is that the receivable will be showing an amount and the payable amount will be different. And the reason why that is due to what's referred to as cash in transit, i.e. the person who is making the payment has recorded the payment, so has credited bank, debited payables, but when that payment has been sent, then it's floating around either in the post, in cyberspace, because the receivable has not yet received the money. If they've not received the money, then they won't have debited bank credited receivable. Now, if they've not reduced the receivable, whereby the other entity has reduced the payable, then you have unequal balances, don't we? So what we need to go through and do there, first of all, the first step is to record the cash in transit. It's a group accounts adjustment, so we just do it in the group accounts only. Don't think about it as anything fancy. Cash in transit sounds complicated. It is just a normal cash receipt from a credit customer. Okay, because you debit your bank, so increase the bank and credit your receivables. Okay, deal with that there. And what should then happen by adjusting for that cash in transit, you can then go through and eliminate the equal intra-company balances. Okay, so you can debit the payable, so reduce the payable and reduce the receivable. Again, do that on a line by line basis. And what you can see is if we add the numbers to the illustration, P has an intra-company trade receivable as $1,500 due from the sub. This does not agree with the corresponding $1,000 payable that is in S's books. And the reason there is because of a check. Do they still exist? I don't think they do, but there we go. maybe in the odd occasion they do. A check of 500 that was sent by S immediately prior to the year end, which P did not receive until after the start of the new accounting year. So S had recorded the payment, but P hadn't received it. So you've got this cash balance that's floating around within the postal system. But from a group perspective, the group still has that cash, doesn't it? But it's not recorded anywhere because S has made the payment, P's yet to record it, so let's record the cash. The cash is 500, so you debit the bank with the 500 and credit the receivable with the 500, so that's your cash in transit. Once you've done that, that receivable that you originally had of $1,500 should now get down to $1,000, shouldn't it? Okay. And then you can process step 2. We now have a receivable intracompany of 1,000, a payable intracompany of 1,000 as well. They are equal, aren't they? So they can then be eliminated. Okay. Yeah, tricky. You could try and do it in one big go by debiting bank, crediting receivable, debiting payable. Don't. Okay, if you do that, you're going to run yourself into all sorts of difficulty. Do it in 2 steps. Record the cash in transit first, and then go through and eliminate the equal intra-company receivable balance. Okay, all understood? All ready for the next one? I don't know. I've had enough. It's too much. I can't bear it anymore. There's one more adjustment, and once we've gone through and looked at that adjustment, we'll pull together the example. If you want, after you've taken a little break, it's entirely up to you. So the next one that you've got is unrealized profits. And what we're going to do is we're going to focus on the illustration first, okay? Because I think that helps and makes you understand it a bit better. Because remember, what we're going through and doing and looking at is the single entity concept. So what you've got there is you've got P, you've got S, and there's my group, isn't it? Okay. And what you've got there is that P has got goods, hasn't it, originally, which cost $100. Okay. So it says P sells $100 worth of goods to S. Is it there at $125? And here, those goods have not been sold by the end of the year. Okay. So when we're going through and consolidating the inventory, we'll add across 100% of P, 100% of S. And the key bit there is that the inventory is now in S's books, isn't it? And it's in there at 125, isn't it? That's what S paid. Legally, from a legal perspective, in the individual company account of S, that's fine. There's nothing wrong with it whatsoever. The issue that we have is when it comes to looking at the group scenario. Because what you've got there is that sat within P's books is that there is a profit, isn't there, of $25. Okay. And that profit of $25 hasn't yet been realized, has it? It hasn't been sold outside of the group, has it? It's just a transfer of the inventory from P to S that created profit within the group. You could sell it at whatever you wanted and make huge, huge profits. And there's nothing that could be done about it because the sub is under the control of the parent. Now, what we want to do is we want to go back to this single entity concept, don't we? We want to go through there and record the cost of the goods at what the cost of the goods were to the group. And the cost of the goods to the group were 100. The cost of the goods at the moment in S's books are 125, and that's what we have consolidated. So as an adjustment in the group accounts and in the group accounts only, to take account of the single entity concept, we are going to remove that $25 as a provision for unrealized profit adjustment, otherwise referred to is it as a PUP or a PUP. Okay. To remove that profit, well, we need to go through there and credit the inventory because the inventory is at 125. We want it to be there at 100, i.e. the cost of the group. So we're going to reduce the inventory by 25. And then to remove the profit, the only place that we can process an adjustment in the SFP to profits is to retained earnings. And that needs to be the retained earnings of the seller. And here the person who sold the goods is the parent. So we would need to adjust the parent's retained earnings, and the parent's retained earnings are in working number 5, aren't they? Okay, because in working number 5, your group retained earnings, we put in 100% of the parent retained earnings and then add on P share of S's post acquisition. But it's that P's retained earnings that needs to be adjusted, i.e. reduced by the value of the put. Just be careful. If it was to be the other way around and S was to be the seller, then S will have made the profits. And if S has made the profits, then S's retained earnings are in working too. Please just be very careful there. That adjustment is made to the retained earnings at year end, or if you like, your retained earnings at the reporting date. Okay. There's quite a bit for you to consider. You need to consider the direction of the sale. Is it P to S or S to P? You then need to make the correct adjustment in the retained earnings of the seller. So if it's the sub working to net assets of the sub at year end, if it's the parent, group retained earnings in working number 5. Here we were quite easily able to calculate the provision for unrealized profit. You may be challenged within the exam by being asked to use cost structures. So thinking about markups and margins. But we'll see all of that when we touch upon the next example. So having looked at the adjustments, let's go through now and bring it in with a full question. Again, we're never going to have to do a full consolidated question within the exam, but as I've said several times before, I do think it's important that we understand how it works overall, to then go through there and help you answer the objective test questions. It really does improve your understanding and helps you get a better mark. Okay, and the example here is going to focus on your unrealized profits. Okay, so what you've got there is a question wants you to work out the statement of financial position for the James Group. So James must be the parent. Is it there the 31st of December? Is it 20x5? That's our year end, isn't it? Okay. Nothing that we haven't really seen already. You can see the assets at the top, liabilities and equity at the bottom. You can see that James has an investment in a company, Molly, of 800,000, which ties into the 800,000 here. So we would ignore that 800,000, wouldn't we, on consolidation? Because we are consolidating, because we bought 80%. We have control, the power to direct the activities, don't we? There is a 20% non-controlling interest. It says the retained earnings were 150,000, so that's going to go into our net asset acquisition calculation. Non-controlling interest is measured using the fair value method, of which we're not told the fair value, so we might have to try and estimate what it is. I do think that within your exam you will be told what the fair value is, but just in case here, we're just going to have a play around with it. And then the new bit, I suppose, it says during the year, Molly sold goods to James at 120 based upon a markup of 20%. So Molly sold the goods. Molly is the sub, isn't she? At 120, markup of 20%, and half of the goods are still there in inventory. Okay, so we have a PUP adjustment that we will need to calculate. Okay. S sold the goods to P, so we need to adjust S's profits, don't we? So let's go through, do all the various bits and pieces. We'll do the consolidation at the end. Let's just focus on the workings, because I think that's the important aspect, isn't it? So if we go through that and look at, is it the net assets of the subsidiary? If you want to refer to it as working two, that's fine. I'm not worried about working one, your group structure. Okay, so here we're going to look at the net assets. Is it at year end? We're also going to look at the net asset to acquisition and those post. We've got there, is it your share capital? We have there, is it your retained earnings? Remember, those figures just come from the SFP, don't, and that should be nice and straightforward. So share capital is there as 200, retained earnings 400. Share capital at the date of acquisition is 200, never changes. And the retained earnings were there as 150. Okay. Previously, what we've done is we've then just totaled up year end, totaled up acquisition, moved on. Okay, to goodwill, non-controlling interest, group retained earnings. But we need to be very, 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 very careful now, because here during the year, Molly sold goods to James. So what you've got there is that there is a sale of goods, isn't there? Some of those goods still remain at the end of the year. So we have a PUP adjustment. So we need to debit the retained earnings and credit the inventory. Remember, we debit the retained earnings, don't we, of the seller. And here, Molly is the seller, isn't she, the subsidiary. So we're going to have to debit the retained earnings, reduce the retained earnings of Molly. Okay, when at year end. So we're going to have a PUP adjustment. That's going to be there at year end. It is never at acquisition. There's never a PUP adjustment at the acquisition date. So PUP adjustments don't affect net assets at acquisition and therefore don't affect goodwill. Okay. PUP adjustments affect your year end net assets and therefore your post acquisition profits. The PUP that we've got, was it a markup of 20%? So is that 20/120th of the total amount sold as 120, but the key bit there is don't forget that half of the goods remain in inventory. So tapping that into your calculator, I'm pretty sure, I'll double check, it's 10. Okay, I remember making it as easy as possible so you didn't need your calculator, but always use your calculator. If you fail to use the calculator, you're practicing to fail the exam. Okay. Total that up, 350 at acquisition. Is that 590 at year end? So that gives me, is it 240 as your post acquisition profits? Okay, excellent. So this example really is all about the impact of that PUP there, isn't it? Okay, if we hadn't have had the PUP, the post acquisition profits, the movement would have just been the 250 on the retained earnings. But because of that PUP adjustment, yeah, it takes it down to 240, doesn't it? Okay. We can then go through and look at, is it the goodwill? So goodwill, if you like your standard numbers, is working 3. So that's looking at what we have paid. Well, the amount that we paid was 800,000. The non-controlling interest is there to be measured at fair value. In most questions, it will tell you what the fair value is. Okay, the fair value is essentially the market price of a share, isn't it? Okay, so what we can do is we know that we've paid to acquire 80%. The non-controlling interest is 20%. So if we work out what each percentage is, so divide the 800 by the 80, that will work out what each percentage point is. Multiply it by 20, gives you 200. So the non-controlling interest is 200. The total value of the subsidiary is 1,000. And then we deduct, don't we, the net assets at acquisition, if you like, from working 2. The net assets at acquisition, I think, were 350. So it gives me goodwill of 650, isn't it? Okay. Everybody happy with that one there? I think the NCI calculation is a bit tricky. All we're doing is working out what each percentage point is and then using that to work out what 20 percentage points are. Okay. As I said in the exam, I do believe you'll be given the fair value of the NCI. Talking about NCI, let's work on with our non-controlling interest working, and working number, is it 4? So we go through there and take the non-controlling interest at acquisition, which is that figure that we took from, was it working 3, that we calculated of 200, wasn't it? To that, we're going to add on 20% of the post-acquisition profits. I think the post-acquisition profits were 240. Let's just check. They are. So 20% of 240 is 48. So 248 is there as my non-controlling interest, isn't it? Okay. Working number 5, remember, is my group retained earnings. So we can put that as working number 5. So what you've got there, remember, that is 100% of the parent. Oh, it's a while since we looked at the financial statements. 100% of the parent's retained earnings is there as 800, isn't it? So I can put in 800 there and then add on 80% of those post-acquisition profits. Does that give me 192? Again, remember, I think the key point to go through and pick up here is that these post-acquisition profits is not simply the movement in the retained earnings, but the movement in the retained earnings adjusting for the PUP adjustment too. Okay, excellent. Everybody happy with where you are there? If you're not, just stop, go back, rewind the video, make sure that you are. Okay, because then what we've got, just to go through and complete it, is we can then go through there and look at the group statement of financial position. The group statement of financial position, what have we got? So we've got my property, plant and equipment, 900 plus 500. Does that give me 1,400? Okay, remember, key bit is that we ignore the investment that we have in the subsidiary because we're replacing it with the assets and liabilities line by line of the sub. And then we put in instead that goodwill. The goodwill is what we calculated. I think it was in working 3. Again, I'll just go back and check. I think, yeah, it was 650, wasn't it? Okay, there we go. We've then got, is it the remainder of your current assets? Is that 700 plus 600? 7 and 6 is 13. So 1,300. So that gives me 3,350. Okay, that's my assets at the top. You hope and pray that it then balances up. If it does, great. If not, not to worry. So remember, your share capital. Your share capital is 100% of the parent only. Be the same if it was share premium, but there isn't any share premium. So here, share capital is 500, isn't it? We then put in our group retained earnings. So our group retained earnings, was it 992? Oh, 992, excellent. So 992 plus 500 gives me 1,492. That, if you're interested in, is what is attributable to the parent. That is what the parent owns. It owns all of its share capital, all of its retained earnings, and its share of the post-acquisition of the sub. But that's just going a bit too far. NCI, I'm going to admit, I can't remember the NCI. 248. Too many numbers going on. So what you've got there, if you add the 248 to the 1,492, gives me 1,740, and that there is the group equity. Okay. Then what you've got, I think there is the current liabilities. Are they 1,100 plus 500? Is that 1,600? Which gives me 3,340. I'm scared to look. I can't remember. What have we got? That's the assets, or that's the equity and liability at the bottom. Oh no, because I know what I forgot to do. 3,350. It doesn't balance. Why? You're probably shouting at me. What you've got there. Criminal, Christopher. Easy mistake to make. You've got there the PUP adjustment, haven't you? Okay. Scandalous. But there you go. Gives me 1290. Gives me there, is it 340? Yeah, okay. Yeah, don't forget the pup adjustment like I did there. I did it deliberately, just so that you would spot it and then you would learn from it, okay? And also just to see that it does happen, okay? Because what you've got there is that we went through, didn't we, and debited the retained earnings of the seller. We also needed to go through there and credit the inventory, reduce the inventory on a line by line basis. So here, inventory was a current asset. I need to reduce it by 10, which gives me then 1290 as current asset. So do be careful. Now, questions within the exam will specifically ask you to work out the current asset figure. Okay, so that's going through there, isn't it? I'm taking 100% of P, 100% of S, and then the PUP adjustments. Okay, we've just said current assets, but obviously that would be specific to, is it there, your inventory. Okay, there we go. Again, I think as well as updating the inventory figure on a line by line basis, the other key aspect that you've got to be aware of is that a PUP, if S is the seller, okay, impacts the post acquisition profits, doesn't it? And those post acquisition profits that you have there of 240 go into the NCI and the group retained earnings calculation. So I think there's plenty of food for thought there. Have a go at a couple of the examples, see how you get on, and if you are getting stuck, then do please let us know on the forums. Other than that, see you all in the next little bit where I think we go through there and start to look at the consideration, so the fair value of the consideration, the amount that you've paid within your goodwill calculation in a little bit more detail.